As we start to turn the page on July and head into August, I wanted to be in touch with a couple of thoughts around what's going on in the markets this week. I'm going to keep it brief. I want to talk a little bit about interest rates, which we had some big information on Wednesday, inflation, and I want to do a real quick follow-up at the end to what I talked about 3 or 4 weeks ago, irrational exuberance, and are we returning to that from the late 1990s? So first and foremost, interest rates. Right on Wednesday, the Federal Reserve decided to keep interest rates unchanged by a vote of 9-3, which means we had 3 governors dissenting against the consensus opinion to actually propose a 0.25% rate hike. This is important for us as investors, especially as bond investors, but also as borrowers if we're looking at mortgages or other rates, to know that the trend with interest rates ahead at the next couple of meetings is likely to be for the potential of a rate hike or 2. And the reason I bring that up, and I'm going to share a chart with you, is all around inflation. And if you take a look at what's on your screen right now, you'll notice some arrows that I scribbled on here to help illustrate a point, but we've really seen a big uptick in the rate of inflation over the last month or two, really as a result of the conflict in Iran, the closure of the Strait of Hormuz, and a big increase in the price of a barrel of oil. And you'll see that green bar on your chart for energy. We've seen a big increase in the price of energy over the last couple of months, but it's not exclusive to oil. We've also seen big increases in the price of electricity around the United States, where our demand has really gone through the roof with data centers and AI and everything else also competing for that same electricity usage. However, if you look in the upper left-hand corner of what I've put on your screen, headline CPI, or Consumer Price Index, is at 4.2%, the highest it's been now in a couple of years. However, core CPI, now the big difference here is core takes back what tend to be more volatile components of our inflation calculation, which is energy and food. And if you notice my couple of arrows here, energy and then dining and recreation and other services have been the big driver of inflation the last couple of months. So core CPI, which is really what the Federal Reserve gauges their decisions on, is still at 2.9, but to them that's still too high. That needs to come down. However, headline CPI, which includes everything, including energy and food and everything else, is up at 4.2. When when inflation's that high, it's really difficult for the Fed to cut rates. If anything, they'll probably have to look to raise rates to combat some of the inflation that we do have ahead. What we find very interesting is a big component of inflation has nothing to do with the Federal Reserve. Rates going up or coming down is not going to reopen the Strait of Hormuz, and it's not going to change the price of a kilowatt of electricity due to demand from competing sources like data centers and AI usage. So the Federal Reserve is in an interesting position right now. We need to manage that carefully for what that may mean for asset values. For those looking to refinance a mortgage, rates have already gone higher. The 10-year government is 0.7% higher in interest rates today than it was just a few months ago. So we've already started to see some of these higher rates embedded in the market, although the Fed has yet to raise on their end. So we're watching interest rates and inflation very, very closely. Big week with Chairman Warsh's comments on Wednesday. And I want to close with just a follow-up. Very interesting news today, Thursday, as a follow-up to what I talked about a couple months ago, or about a month ago, around irrational exuberance. I think when Federal Chairman Greenspan had passed away, going back to his speech in 1996, and I was questioning, are we getting a little bit exuberant in the markets? And there was some interesting news today. A big hedge fund run by a 25-year-old that had just recently left OpenAI had to liquidate all of its publicly traded stocks after massive losses, massive outflows, and huge declines in some of the holdings that were in that hedge fund. He ultimately sold those positions to a very tenured head of Citadel, Ken Griffith, but marks a real symbol of irrational exuberance, where this hedge fund got up into the tens of billions of dollars in assets in it within an 18-month or so period of time, and today is having to unwind all those assets after a pretty steep pullback in a lot of the positions in AI and other areas. So does that mean we're being irrationally exuberant? I don't know, but the evidence is certainly out there that warrants us, when we look at the markets, to take caution first and look at opportunities second, and make sure that we preserve a lot of the growth that we've seen over the last couple of years. So with that, have a wonderful weekend. Thank you for all your trust, your confidence, your advocacy in us here at Stablepoint. We look forward to talking to you soon.